Hello and welcome to the Life by Design podcast, brought to you by Strategic. This podcast is all about helping you live your great life. Each episode will feature insights from our Chief Investment Officer, Doug Walters. Hello and welcome back to the Life by Design podcast. I'm back again with Doug Walters. Hello, Doug.
Hey, Jay. How are you?
Fantastic. Thanks for coming back. And so we're going to dive later into alternatives again. We're going to get a little bit deeper. We covered a little bit on private equity, gold. We've covered some of the alternatives, but we're gonna take a deeper dive into that today. But first up, a little bit of your insights from this past week, things that you're looking ahead to, and just anything you got.
All right, sure. Well, we've been saying for a while, and we're not the only ones, that tariffs are very important. But the other thing that seems to be taking a back seat lately is the Fed and its decision on whether or not to reduce rates. And what's driving most of that is inflation. And we had an important inflation read last week. So CPI inflation came out. That's the Consumer Price Index. And it was a bit lower than expected. It's not quite down to the Fed's 2% target, but it's continuing to move down into that, towards that range. So that gives the Fed something to think about this week, because on Wednesday we have a Fed rate decision. It's not expected to change the calculus. Currently, markets are not expecting a cut this time around, but it certainly starts to make that case for a cut. I think where the hesitation lies is the impact of tariffs really hasn't been felt or seen yet in the inflation number. So the Fed is still probably in a wait-and-see mode.
Right. So technically, in regards to tariffs, a lot of the reactionary things that we've seen in the market is more to the news of tariffs than the actual consequences of them.
Yeah, it's a bit of both. Right? They were trying to infer what the consequences are, but we haven't actually seen those consequences in numbers yet.
Yeah.
That is, should be coming soon if worst fears are realized.
Yeah, and I know, from my perspective, some of the things that I'm interested in, there's already been announcements from some of the manufacturers of those that oh, hey, we have a little bit of a price hike because of X, Y, and Z. And I think some of this, is most likely tariffs are mixed into that as well.
Right. Yeah. And we do see, while the consumer price index is down, we have seen some data on the producer price side that is suggesting that these prices, they're starting to see higher prices.
Okay. So that is our insights from this past week and what we're looking ahead to. So now, let's just dive right in. Doug wanted to come back on here and talk about alternatives again.
Yeah.
So here we are. So Doug, I'll let you lead it off and I'll ask questions as we go.
Yeah, sure. So you kind of challenged me this week by talking about barbecue in Insights, right? We had a nice interview with Abdu and Chef Abdu. And I got to thinking about ingredients and good ingredients and bad ingredients, and it really brought me back to this topic of private equities as kind of bad ingredients for most of our clients' portfolios. And the reason it's really topical today is, and we kind of mentioned this in the past, we're starting to see an influx in our email box of this fund or that fund being private funds being pushed down to individual investors. And so we've done a lot of work making sure we understand the risks and the potential rewards for these, and really want to talk about that today.
Yeah, and so just as a real quick reminder for folks, a private fund is what?
Yeah, sure. So it's really the opposite side of the equation from a public fund, and the public fund is what we are most familiar with, and we'll talk. Let's broaden it. Public investments, right? Stocks. Yeah. Everyone is familiar with the stocks. Those, you are buying a public company, meaning it trades on, say, the New York Stock Exchange. You can buy it and sell it intraday. It's regulated in a certain way that public companies are regulated in. And but really, you get that day-to-day liquidity. You get a requirement from those public companies in terms of how they have to report and be open about their business and their books. The contrast to that is private companies, and private companies have decided not to list on a public market, but there still are ways to invest in those private companies, and that is through firms like Apollo, Blackstone, who will basically buy a piece of these private companies and then bring investors in to own a piece of those private companies.
And so I guess to distill it down to its simplest form for me is that the public, the stocks, all that is you have knowledge available to you and there's a known there, where with the private, it's not as regulated. So there's more of an unknown there.
Right. And the reason that you are, the regulation is allowed to sort of take a step back, if you will. You have to be an accredited investor or, meet some investing threshold in order to invest in them. The SEC doesn't want someone, spending their last dime on a private company that is less regulated and, we have less information about.
Yeah, and we had talked in the past that having a certain dollar amount in the bank is like a requirement, or available assets to invest, stuff like that.
Right. There's multiple criteria, and there are different, depending on the investment, there's different types of accreditation, but typically it's income-based or net worth-based.
Okay. All right. And so you were kind of talking before we started that one of the things that kicked off this for you and kind of thinking about this was that you said that Harvard and Yale were forced to liquidate some of their private funds.
Right. So they're dealing with their own issues in terms of some federal funding being cut, and one of the ways they're managing around that is to exit some of their private equity, private investments within their endowments.
So is that private investments that they had their money invested into, or is that private investments that people could invest in them?
It's that they had their money invested.
Yeah,
right.
Okay.
So they had, a portion of their portfolio, a very large portion of their portfolios tied up in private investments. And the one thing we've mentioned in the past is, one of the risks with private investments is they're not very liquid.
Yeah.
You are typically locked in for a period of time. And, for you and I, we'd be stuck for whatever the lock-in period is, 7 years, 10 years. For Harvard and Yale, they've got a little more sway. They can potentially find secondary buyers for the funds or the companies that they own. And so that's what they're in the process of doing, is finding some secondary buyers so they can liquidate a portion of their private holdings.
Okay. And so that kind of starts to affect downstream investors a little bit, right? Because now that that's happening, whoever is out there trying to sell on this secondary market is going to start approaching downstream, right?
Right. And that's, this is where a little bit of speculation comes in. We always say we don't like to speculate.
Yeah.
But we do want to prepare. And what we're doing is preparing for an increase in a push, because these have to go somewhere. And it's quite likely, given there's a fair amount of glut right now in the private equity industry, we're likely to see these being pushed down to individual investors in various funds that are trying to attract them through slightly different structures that make them a little more accessible.
Okay. And so how does that structurally differ from things that like an ETF or something that we do?
Yeah, so an ETF, which is an exchange traded fund, and as the name suggests, that means it is traded on an exchange just like a stock. So, ETFs can trade on the New York Stock Exchange, which means you have, minute by minute liquidity. You can get in and out very quickly and easily. These funds are going to be less liquid.
Okay.
So a traditional like buying right from the source, primary private equity, you're going to be tied up for 7 to 10 years. What we're seeing is these companies getting creative, trying to say, how do we get, Jay to buy a piece of this? Well, we're going to try to create a little more liquidity, maybe give him the ability to sell some of it on a quarterly basis. And they do that by combining different ways. But one way would be to say, take these private investments, put them in a fund, add some more liquid public securities in there as well, maybe infuse some cash in there.
Mm-hmm.
So to create a little more liquidity. So if you wanted to sell 5% on a quarter, you might be able to. So they're trying to get creative to, again, broaden the universe of access. Now, the problem with that is, and you're hearing what I'm saying, you're really diluting the whole point, right? If private investments are, can produce higher returns, well, why are you going to dilute it with public equities, or even worse, with cash to make them more liquid?
Yeah. And then I guess one of the things too, in regards to that, is fees as well, right? So I'm assuming that there's some sort of fee on these. They're not just free money.
Yeah.
So, when we look at, from our perspective, being a fiduciary, we have, our fee for operations, and then there's the fees for trading on ETFs and stuff like that. So like, how do they manage theirs in comparison?
Yeah. So it is, it's a loaded question. And
good.
What I will do is spout some data to you.
Okay.
Because there was a good study done a year ago. So this is relatively up-to-date data looking at different private investments and the embedded fees that are in them. And the fees can come in the form of a management fee. Mm-hmm. It can come in the form of a performance fee. So if the fund clears a certain hurdle, let's say, if it goes up more than 5%, then the fund company might take 20% of everything above that. And so what does this look like in terms of numbers? It can range anywhere from 5% to 9% fees, according to this study, with, the private equities tending to have the higher fees, 8 or 9%.
Mm.
And so this is coming right out of what you would be taking home as the investor. So this is the big hurdle to clear. And let's compare that to an exchange traded fund. One of our core funds is a U.S. multi-factor fund. It's an iShares product, LRGF. It has an embedded expense ratio of 8 basis points. That is 0.08%. So compare 8% to 0.08%.
Yeah.
It's a big difference.
It's leaps and bounds. Yeah. And so it's interesting. And so one of the things I hear a lot, and maybe someone at home has heard, is the word drag when talking to fees. And so so when you talk about that 8% versus the 0.08%, is that drag?
They both are drag on performance.
Yeah.
One is a much bigger drag, 100 times bigger drag.
Yeah.
And by that, I guess it's really, if you think about, I suppose it's an engineering term.
Mm-hmm.
Think about, a car trying to be aerodynamic. What it's trying to do is reduce drag, and it's trying to reduce anything that might slow it down.
Okay.
So it's, think about that with an airplane is probably a better example. You want to reduce drag as much as possible. That's the term we're using with investments. You want to reduce anything that's going to slow down your performance.
Mm.
And these fees are like as direct as it gets in terms of slowing down performance.
Well, that's good. Okay. So anything else you wanted to cover on the alternatives?
The one thing we really didn't hit was performance.
Yeah.
So which is really important because, these private investments have a lot of hair on them in terms of liquidity and maybe excess risk and less regulation, but are we getting more performance for them? Is it worth it? Is the question. and there's some good research out there. It looked at pensions and endowments. Now, these are the biggest pensions and endowments in the country. They have the best access to private equities. They are big users of private investments. And so this study looked to see how they did. And what it found was the more in the way of alternatives and private investments they put into their portfolios, the worse their relative performance was. So private investments were actually a drag, and they were able to break it down by type of investment. The best performer was private equity, which was sort of net neutral. So private equity didn't hurt or help their relative performance.
Okay.
Everything else, private credit, commodities, everything else that you might fall into that category, alternatives, was a drag on performance. So, and these are, let's just put this in perspective, these pensions and endowments, they have big research teams, they have big budgets, they have best access to these private equity firms, they have sway over them, they probably have advantageous pricing, yet they weren't able to make it work.
So, moral of the story, if I'm hearing this correct, and you correct me if I'm wrong, is that with all their funding, their research, their thoughts, everything that they have, they still couldn't really make it work. So the expectation of someone like myself, way downstream, probably even less likely.
Right. These products that are being pushed to individual investors are subpar compared to what these pension funds would have access to.
Mm-hmm.
They're going to be less potent versions of private equity. They're going to be expensive. They're going to have liquidity concerns as well. You're going to have trouble getting in and out of them. And they're not going to be the cream of the crop, most likely.
Mm-hmm.
Again, a little bit of speculation there, but
there's always exceptions.
Right, because everyone talks, and when you hear about alternatives or private investments, you hear about, top quartile. Well, you have to have top quartile access. Well, the individual investors are not going to have top quartile access. So,
all right. I mean, I think that's a great place to end the conversation.
All right.
Perfect. Thank you, Doug.
All right. Thanks, Jay. Take care.
This podcast is for educational and informational purposes only. Please see the full disclosure in our show notes for more information.